I think one of the areas that you will not fail to notice within as attributable to the KBA is the evolution of the clearing system. Initially, it was a manual clearing system, and the mere fact that we were then able to bring in the check truncation process and convert the manual processing into an electronic processing, and therefore achieve a more efficient and a more secure clearing platform. I think that's one milestone, and this is a project that was implemented in partnership between the KBA and the CBK. That's one. And then the other one is what we call the CRB, the Credit Reference Bureau, which is a project that is being implemented again by the KBA, and it's a case where now we are able to appraise a client on the basis of the information unique to the client, rather than relying on a gut feel, for example. And so by developing this mechanism where the information about an individual is collected, and we can then be able to get a credit report on the individual, and the individual can use that report to be able to negotiate for better terms in terms of either collateral or in terms of the interest rate that he can negotiate with the bank. I think for us that's a major milestone, where the benefit would be accruing to the individuals, and the individual can then be able to differentiate himself. When he's a good borrower, he gets the benefit for it. And when he's a bad borrower, he's actually the one who bears the cost rather than spreading it across to everybody. I think one of the things that come to mind normally when you talk about the economic challenges is the usual comparison in terms of the cost of credit. Because somebody will normally say that I'm able to get a loan, for example, in the US at 3-4%. And how come in Kenya I cannot get anything below 17% or below 15%? And normally that difference is what quite a number of people cannot understand. And so as KBA, what you have tried to do is to educate or to get the information out there on why that kind of a difference can actually exist. It's not that the Kenyan banks are overcharging you or anything, but it's just that the economic reality in the two economies are different. And so we try to expound on why such a difference would occur. And really, when you look at the reality, is that in terms of arriving at the price of credit, in Kenya, there are a number of factors that come in. One of them is the cost of funds for the banks. The other one is the operational overhead that the banks have got to incur. Then the third one is the credit risk margin that the banks have got to load on, in view of the fact that when that money leaves the bank, it may never come back. So the probability that that money may not come back translates into a risk, and that's the risk that you load onto the cost of funds to on-lend the funds to the consumer. Now, those various components are determined by different drivers, and so it's our duty now to let the consumer know the interplay between those variables in arriving at the cost of credit. I think I'll look at them as the main challenges. Actually, I'll look at them as twofold. One is there's a huge proportion of Kenyans out there who either are unbanked completely or they are underbanked. So from the statistics available, we are just about, I think in 2009, the data was at just about 30% of Kenyans who are banked. So there's a huge proportion of Kenyans out there who don't have access to banks or are inadequately accessed. So they don't have all what they require from the banking system. And our challenge, I think, as an industry will be to access our services to those Kenyans who do not have access. The other challenge is the cost of those services. There's been, I would say there's been more or less like an outcry of the fact that the cost of the banking services, and maybe not just banking services, but I'll say financial services, is too high for the consumer. And so we have got that twin challenge: access our services to the person who is not currently being accessed, and bring the cost of those services down. And I see the role of technology coming in very strongly in this twin challenge, both in terms of getting our services to the consumer and bringing the cost of those banking services down. If you look at the accessing the consumer, we already have mobile banking, which is the interplay now between the mobile telephony and the banking services. And even though initially the uptake of mobile technology was not quite as popular within the banking industry, I think over time banks have realized that there can be this leveraging on each other between the mobile telephony and the banking platform to be able to access the customers who are already having the telephone, mobile telephone access, and get your services through this mechanism to the actual consumer. So you see the telephone, mobile telephone, as a distribution channel rather than as a competitor for your services. And I think once that message starts getting through, we are seeing a lot more innovations coming in along that platform. And I can mention one example, the M-Shwari product, which is a recent innovation that two entities, one a bank and one a mobile phone company, have come together and unleashed a product out there in the market that is picking up quite well. I think what tends to happen is that as a microfinance institution develops, and then it becomes a deposit-taking microfinance institution, and then it gets licensed by the central bank, because from the microfinance institution, when you become deposit-taking, you're then licensed by the central bank. And so the regulatory environment that you're facing is similar to what the banks face. And so your operations start becoming like a bank. And some of them now find it easy to start upscaling. So even in terms of their clientele, you have got the basic original microfinance client that you had, but then you start upscaling up to maybe start serving the SME. So in your corporate clientele, you've got the SME clientele. And slowly, as you upgrade and you start picking up bigger tickets within the SME area, you start encroaching into what initially was being served by the banks, because the banks are also, rather than just serving the big corporates, they are also scaling down to start serving also the microfinance, the SME sector that requires smaller tickets. And so over time you see that there's that overlap. And that overlap means that the microfinance entities start encroaching into the areas where initially only banks would go, but also because the banks are seeing an opportunity in the areas where they have not been, they are also downscaling. So there's that overlap, and I think that overlap is good, because then the consumer there is the one who benefits. He can either go for the bank, or he can go for the microfinance entity, or as the microfinance entity converts its operations into almost like a bank, for the customer there's no difference between an original bank and a former microfinance that has become a bank. We have seen the debate picking up in terms of having a stronger banking industry. And by a stronger banking industry, it means that the capitalization going up. And one of the ways of forcing the mergers and acquisitions so that you have got stronger banks is just overnight to increase the minimum core deposit, for the minimum core capital that the banks require. And that increase will then force banks to consolidate. But there's a bit of reality that we need to bring in. Currently, if, say, for example, you increase the minimum capital from 1 billion, which it is today, to, say, 2 billion, you possibly may get one or two banks having to consolidate to be able to hit the 2 billion, but all the others would be already above that. So you will reduce the banks from the current 43 to 42. You will not have achieved much. And now, when you increase it from, say, 1 billion to 5 billion, again, you might have about 5 banks that may have to consolidate. So again, you find that you might not have achieved much. It needs to be some very drastic move, say from 1 billion to 10 billion.
There must be a reason.
And there must be a good reason for you to have the 10 billion requirement. And I think if it's just the issue of adequate capitalization, there is even an argument that the capital should be reduced so that banks can now be able to serve the regional markets that are developing, so that a bank can focus on a particular county and serve that county and serve it well. Now, so there are those, developing arguments, and whichever way, but I think at the end of the day, we need strong capitalized banks that can be able to withstand any external shocks that may hit the market. And so it will be incumbent upon the regulator to assess and see at what level should we be increasing the minimum capital required for purposes of adequacy of the capital base, rather than for the sake of having the banks consolidated. We have got commercial banks that have come and set a base in Kenya. And I think most of them are not looking at Kenya as a market. They are looking at the EAC as a market. So most of them have come into the market with the wider perspective of the EAC, but possibly having a base in Kenya. But they are looking not at Kenya as a market, but as the regional market. And for this, we can talk of the likes of EcoBank, which is a West African bank that has set up here. We have got UBA Bank, which is a West African bank again that are set up here, and they are setting up from a regional context. And that is bound to continue. And in a way, that shows that as a region, we have become an attractive investment horizon, not just for Kenya, but for the region. But having said that, we are also seeing another trend. When you talk about foreign banks, we are now got about 7 foreign banks that have been licensed as representative offices in Kenya, which means that these banks are seeing some attraction of even given the fact that Kenya is developing as a regional financial hub. And they're seeing Kenya as a good entry point into that market to tap into the opportunities that they are. There are huge infrastructure projects that will be coming up, especially with where Kenya is and where the region is. And it will need serious players, and they are seeing that as an opportunity. And so they are already coming to position themselves to take advantage of those opportunities. And based on how they develop their portfolio, they will then be able to decide on whether they want to now have a fully fledged bank in the region or not. As an industry, we are proud of that, because one is that the Kenyan banks that are spreading into the region are more or less are our ambassadors. They are spreading our good banking practices into the region. And you've seen quite a number of Kenyan banks, and in fact, some banks are in all the 5 EAC markets, EAC member countries, including South Sudan. If you look at most of the Kenyan banks currently, the strategic plans, most of them have got the idea of going regional or tapping into the regional markets. Either in the medium term or in the long-term plan, they'll have it somewhere, because they are seeing those opportunities in that Kenya as a market has got the right practices and the right structures to be able to exploit the markets that are opening up within the EAC region.